Wait, what? I can do that? This is Eric Bell with Wait, What? Financial matters that matter for business and the people that own them. Welcome to this episode of Wait, What? Financial matters that matter. I have returning guest Sean Bragdon, who is partner and managing director for BGA Insurance here in Costa Mesa. Today's topic is life insurance premium finance. Thanks for being here, Sean.
Thanks, Eric. Glad to be here.
I was going to ask you, what is premium finance, life insurance premium finance?
Well, essentially, it's just where a client is going to borrow money to pay for a life insurance premium. That's basically what it is.
And why would a person do that? I don't really understand why they would do that versus spending their own money for a life insurance policy.
Well, if it's done correctly with the right client, you can get a lot of leverage with a premium finance transaction. And in essence, you can get more bang for your buck. We bump into clients that maybe are not liquid. They're making a lot of money in their own business. You know, you have a business owner that's making 20% on his money in his business. He might be reluctant to use those dollars, even though he knows his family needs maybe a large life insurance policy. There's also some gift tax leverage when it comes to using premium finance. So there are certainly a lot of good reasons.
Is there any particular type of client that qualifies, or does everyone qualify for premium financing for their insurance needs?
Historically, premium finance has been just for the very wealthy. In fact, in the past, insurance companies required that a client have a net worth of at least $5 million before they'd even allow their products to be used in a premium finance strategy. Nowadays, there's been some improvements or some changes, and there's actually some small case premium finance platforms where, as long as the client is, 65 or younger, makes $150,000 or more in annual income, they can implement a premium finance strategy.
Now, I know in insurance that younger people, it costs less for insurance. Does that work the same with premium finance?
Yeah, actually, the younger the better, because when you're designing a premium finance strategy, you have mortality costs, expenses, and older age insureds, often it's a challenging type of prospect to make that work. Typically, you're going to max out at about age 65 for a premium finance strategy, but if you get the right underwriting decision, maybe you can get it up to about age 70. So the younger the better, certainly.
You mentioned that the lack of liquidity would be a reason to do premium finance. What are some other primary reasons that people would do premium finance?
Well, what's becoming kind of popular now is people are using premium finance to design a retirement plan. They're, in essence, leveraging their retirement plan using premium finance. There's one particular design that's quite popular where, you might have a successful business owner. He contributes $50,000 a year for 5 years into a plan, and then he's going to borrow $50,000 a year, and then an additional $100,000 years 6 through 10. So in that type of design, the client might contribute $250,000 into the plan, but he's got $1 million working for him for a retirement plan. So it's a pretty attractive design.
And if I remember correctly, when you do those loans, they're tax-free. So it's tax-free income.
Correct. Yes. So you pack a lot of money in a tax-free environment like a life insurance policy, and you can pull it out completely tax-free. A lot of people don't realize that there's really only 3 products in this country you can enjoy tax-free. You got a Roth IRA, which you can only put in $6,000 a year into. You got municipal bonds, where you maybe get a 3% yield today, and even muni bonds are subject to AMT and
provisional tax.
And maybe increase your tax on Social Security. And the only other item is cash value life insurance. So it's definitely a good spot for a supplement retirement plan.
What about for an estate? Someone who has right now the estate exemption is at $11.4 million per person. How would this work into that premium financing?
Actually, out of all the cases that I've been involved with over the last 20 plus years, that's the most common reason someone is going to do a premium finance structure. You have a very wealthy individual, has got an estate of $50 plus million. He's maybe already gifted his lifetime exemptions to his kids and heirs, and any additional premiums going into a large life insurance policy might expose them to a gift tax. By using a premium finance strategy, a wealthy individual can buy a very large life insurance policy, not have to pay a gift tax, and he can get all that assets outside of his estate. And the reason they do that is when you die, the IRS is going to charge you a 40% estate tax on anything north of your annual exclusion of $11.4 million. And in 7 years, that $11.4 million exclusion is going to drop to about $6 million. So any estates north of $6 million are going to get hammered by a 40% estate tax. It might be the wrong time for that family to sell their real estate. They might have to sell a family business to pay the estate tax. And it's just a smart idea to get a life insurance policy to pay that.
Pennies on the dollar.
Pennies on the dollar.
It's always good. I know there's several different types of life insurance. There's whole life, variable life, universal life, and index universal life. Which type of insurance is best for premium finance?
In my opinion, an index universal life product is far and away the best insurance product to use for a premium finance structure, and it's the most commonly used one.
What makes you say that?
Well, first off, you got a lot of upside on an index universal life product because you're getting the upside of an index like the S&P 500, but you're contractually guaranteed to never have a negative rate of return. So, you might be getting, a 7, 8, 9% return on your index UL, but if the market drops 35% like it did in 2008, you're guaranteed to get a 0. So having that type of mechanism to get tax-free returns, it's just a real good fit.
And digging out of a 38% hole, 35% hole is a big hole to dig out of.
Absolutely.
If you got a guarantee of 0 on the downside. When you premium finance, what kind of lending rates can you borrow at?
Typically, in a premium finance structure, you're with a wealthy individual, we will help them negotiate terms to get the very best lending rate out there. There's a lot of banks in this space, but it's going to be based on the creditworthiness of the client. There are a couple of options out there where, as I mentioned, the small case premium finance platform, where they are pooling together many like-minded clients that want to enter into a premium finance structure. And by doing that, pooling together like-minded individuals in a tranche, they're able to tap into some of the best lending terms in the marketplace. Typically, in a premium finance strategy, if you want to get the best lending terms, your initial loan, you want it to be at least $1 million, and then you can get the best terms out.
So what are the ranges in terms of interest rate on borrowing?
Typically, right now, you're seeing interest rates somewhere between 3.75 and 4.5%.
Okay, now does the client's bank give them the loan, or do you have lenders? How does that work?
Both happen. Typically, with a large premium finance structure, you're talking about a client that has banking relationships already, and often that's your best place to look for an attractive loan. Who do you bank with? And then we ask them. And the key with a lot of these premium finance structures is the collateral. If the client already has a banking relationship and has millions of dollars at that bank, you don't have to ask them to collateralize or move those assets to another bank to get the loan. You go with their current bank. But we bump into a lot of cases where we're going to find a lender for a client because their bank isn't providing good terms or just not in this space. Not all banks are in this life insurance premium finance space.
Okay, so you have lenders in addition to their bank possibly?
Yes.
All right, good. So you got a loan. To me, you got to pay it off sometime or another. How do you pay off the loan with a premium finance case?
Yeah, a typical design, you are usually paying premiums for 10 years. And you're putting the maximum premium in that life insurance policy to build a lot of cash value. The reason it works, if I'm borrowing money, say at 4%, and I'm getting a 7% return on my life insurance policy, you have a built-in arbitrage. So at some point in time, you're going to have enough extra money in that life insurance policy to pull it out and pay off the bank. Typically, depending on the age of the client and the underwriting decision, you're able to take that arbitrage and pull the money out somewhere between years 11 and 20 to pay off the lender. So that's one option. You're using the extra cash in the policy to pay off the lender, leaving you with a paid-up policy or a policy with a ton of cash you can use for retirement. We have many other cases, though, where there is a built-in exit strategy that the client already has in mind. You have a client that intends to sell his business over the next 10 years. You have a client that expecting a large inheritance down the road. So there might be a client that is planning to sell a large piece of real estate at some point in the future. So any type of liquidity event like that could certainly be used.
So with insurance, you're already using pennies on the dollar. Now we're talking about leveraging through the loan. You're also getting the upside of the S&P market with no downside. This sounds real good. What's the downside to premium finance?
Sure. So you have some moving variables. The lending rate, that is not a guaranteed rate. It's a moving number.
So it's a variable rate.
Yes, most of the loans are LIBOR-based loan. 12-month LIBOR is currently going around 2%. You're going to add a bank margin on top of that. And so that's a moving target.
Can you get a fixed loan?
You can, but it's not common. The largest fixed rate you maybe get in today's environment might be 5 years. You could probably get a 10-year, but the rate is so high, why go there? Most of the people that are implementing these strategies are using a 12-month LIBOR rate or a 90-day LIBOR rate. Those are the most commonly used lending rates. So, yeah, the downsides with premium finance, again, are the lending rate. It's variable. It moves. It's a 1-year LIBOR rate typically, so that's going to change every year. So your loan interest is going to increase potentially. You also have the index universal life crediting rate. That's a variable rate. It goes up. It goes, you either get a positive rate of return or you get a zero. And so if your projection doesn't hold true, the client is either going to have to post more collateral or pay more loan interest or possibly both. And so typically you want to prepare a client for potential changes in the future.
Yeah, I've seen very aggressive, and I guess I would call them inaccurate premium finance proposals. I guess case design is key to this.
Case design is critical in managing your client's expectations. My crystal ball broke a long time ago, but we are typically designing strategies that have a high probability of occurring. But in the marketplace, you're going to see very aggressive proposals sometimes. And some of them are just inaccurate. You might see a proposal where the client is assuming they pay no loan interest, they are not paying any of the premium, they're borrowing everything and letting all the interest accrue, and they're posting little collateral. That's pie in the sky, in my opinion. You have to either pay loan interest, pay some of the premium, and or add collateral to a structure to work. And if it's structured correctly, these are very attractive designs. The internal rate of return on the benefits are staggering, double-digit numbers on a proper design. But there are some aggressive models that I've seen floating around in our industry.
Now, I got two questions in regards to collateral. One is, what percentage of the loan do you have to put up in terms of collateral? And the other one is, for real estate people, can real estate be used as collateral?
The amount of collateral a client's going to post in a premium finance structure is going to be based on the design. So there are some designs we have where the client is not going to post any collateral other than the life insurance policy. One particular design might be a client pays $50,000 a year, years 1 through 5. He then borrows $50,000 years 1 through 5, and then he borrows $100,000 years 6 through 10. So in that example, the client put $250,000 into that policy. He's got $1 million working with him. The fact that he put the $250,000 in the policy, there's enough cash in that policy that he doesn't have to post any collateral other than the policy itself. That would be a good supplement retirement type of design. That's a common design. Other designs, you might have the client is borrowing $1 million a year for 10 years. The client is paying loan interest maybe for the first 5 to 7 years, and then he lets it accrue thereafter. And that type of design, that client's going to post collateral. That collateral needs to be liquid collateral. The banks don't want real estate. They want assets that can be liquidated within 72 hours. So we're talking about stocks, bonds, mutual funds, cash, CD. Rumor has it that you can use real estate as collateral. I haven't seen it done. When you hear someone say, hey, you can just use your real estate as collateral, what ends up happening is they just refinance your $1 million apartment that you have, and they pull equity out of it, and now you have 2 loans. There might be a bank out there that just will use unencumbered real estate as collateral. I haven't seen it yet.
Someone told me a letter of credit against real estate might
yeah, work. That's actually a very commonly used mechanism for collateral. So you have a client that's got a good banking relationship, and they'll provide a letter of credit on that client's behalf for the collateral. Typically, you should be charged somewhere between 1 to 1.5% fee for that letter of credit from your bank. So yeah, that's also a common option.
Well, we've talked a lot about premium finance, Sean. I'm trying to, if I have any other questions. You have anything that you can think of that we haven't talked about in regards to premium finance, insurance premium finance?
Well, we illustrate premium finance strategies a lot more than we actually see them get done. Typically, you're looking for wealthy people that have net worths exceeding $5 million are the people that really pull the trigger on a premium finance structure. Often we will show someone a premium finance structure and show the alternative. Here's if you just stroke a check for the insurance that you need. And as long as we're explaining, the pros and cons on each option, you let the client decide. So, for the right client, premium finance can be very attractive. It can save the client a lot of money as far as the cost of the insurance that they need or want, but it's not the right fit for everyone.
If you're illiquid, then that's usually a good situation for someone then.
Well, yes and no.
If they have the wealth.
Yes and no, because usually the lenders that are going to lend in the space are looking for some amount of liquidity that the client has.
Okay.
On larger leverage premium finance structures. But on that small case platform that I mentioned, if the client is going to be paying some premium into the policy, they don't need really any other liquidity other than the amount of planned premium.
So for estate, I got that, and I always knew it could be used for estate, but that's pretty new that I didn't know you could use it for retirement planning. That's a good deal.
Yeah, that's fairly new in the premium finance space. That if you have that not wealthy yet business owner, for example, you got a guy that's 47 years old, he's making a lot of money, he's not, doesn't have a huge net worth yet, but he probably will in the future. It's a good opportunity for a person like that to leverage their retirement plan, and these are policies that are usually put into a trust, and so you might have the flexibility of having a policy that could be used for retirement needs and estate tax issues down the road.
And you use the age 47, so this is not for the guy who's 63 and wants to retire at 70. Premium financing for retirement, I mean.
I've seen
not
plans.
A long enough runway.
I've seen plans out there that go up to about age 65 for even a retirement plan, leveraged. Keep in mind, if you're 65 years old, you got a life expectancy of 20 plus years. You probably have other assets that you can tap into for your retirement initially, and you could let this thing sit and stew and tap into it later. So up to about age 65 is going to be the max, but most of the cases that I see that are actually getting placed for a retirement plan using premium finance are going to be 55 and younger. That's kind of where you're seeing most of it.
Thank you for being with us, Sean. Are there any other questions that I could ask you in regards to life insurance premium finance?
The only thought that comes to mind is I've seen a lot of people that are touting premium finance, but they're not experts at it. You want to find someone that's done this before. If you have some advisor that's pitching premium finance to you, make sure they've done it before, because it is complicated, something that needs to be monitored on a regular basis, and it's challenging to put together. So have someone with experience.
With that answer, I got to ask you. You say it's something that has to be monitored on a regular basis. What's the process in terms of getting premium finance or financing? Do you need tax returns or?
Yes. In order to get the bank loan, you're typically looking at 3 years of financial statements and or business tax returns. So that's a detailed process. And, the information the insurance carrier needs for your underwriting, that's going to include not only financial information, but medical information. So there is a bit of a drag on the time frame to get a premium finance structure put in place.
Because you're qualifying two places, both financially and also medically.
Yeah, a typical premium finance case might take you, 3 to 4 months from start to finish.
Well, thanks for being with us, Sean. I appreciate you coming back in as a return guest.
Thank you, Eric.